Yeah, we're back here on Morning Trade Live. We're talking Oracle. Stock's off a little bit today and giving up more than 41% of its gains since hitting those all-time highs that we saw in early September. Oracle is in the news today due to an upcoming $38 billion debt offering to fund the next phase of its Stargate project with OpenAI, another round of debt offerings here for the company. That's going to be the focus of Morning Trade Live here. Let's bring in our next guest. It's going to be Marley Kayden. She's the host of Trading 360 and Market on Close. So Oracle's in the news. We talked about this earlier in the session. And this is a big deal because I think the pullback that we've seen, everybody was high on Oracle when they announced this $300 billion deal with OpenAI. But now when you start taking debt on to build out this AI infrastructure, that's going to be a concern for investors, right?
It potentially could be, sure. I mean, you mentioned the pullback. Just in the last month alone, we've seen Oracle pull back more than 28%, well off of those highs, like you mentioned, that we saw earlier in September. You mentioned this new funding round. There are several banks discussing this potential $38 billion loan package for Oracle alongside its data center builder Vantage to fund those additional sites for OpenAI. Now, this is not their first debt offering, of course, as you're hinting at by saying the investors might have some concerns here. They're taking out more debt, but it is the largest offering to date if this one does come to fruition. They took out an $18 billion debt financing back in September, late September, to support some of these massive data center plans already, including those Stargate campuses. Now, OpenAI back in September as well disclosed plans for 5 different Stargate data center campuses in the U.S. alongside their existing one they already have in Abilene, Texas. That construction has already begun. Since then, analysts have started to try to estimate how much might need to be taken out to just meet the contract alone with OpenAI. And right now, the number sits at about that Oracle would need to source up to $100 billion in debt funding over the next 4 years just to meet this OpenAI contract alone. Now, that said, it's not being viewed by the sell side in a bearish way. We got a note from Deutsche Bank saying that this sell-off actually offers a really attractive entry point. The analysts also made note that they don't think that Oracle is given little, they said, quote, little, if any, credit for its business with OpenAI, and that while the deal brings financial and operational risks, these are offset by what they call a very real opportunity that OpenAI offers. And that's a very interesting perspective, Tom, because we've had a lot of these conversations about the cyclical spend and how a lot of these headlines are driven, and we see these shares pop to the upside. But now with a lot of this AI bubble conversation, we're starting to see them met with a little bit more scrutiny and a little bit more caution. So interesting to see Deutsche Bank putting out this pretty bullish note when we've seen a significant pullback in Oracle.
Yeah, and the note out of Deutsche Bank, they're kind of reiterating their $375 price target, and then the day before, D.A. Davidson came out with a note lowered from 300 to 200, and this is based on OpenAI. So maybe just a quick follow-up here on this partnership and how everybody was on board if you partnered with OpenAI. Now it's kind of reversed, where is OpenAI, with all these commitments that they have and this roundabout circle of investing that we've seen from, the chip makers, OpenAI, others in this space, it's going to be maybe some volatile times here because if you're tied to OpenAI, it's a positive, but at the same time, are they going to come through on those commitments, right?
I mean, I think that's what everybody's waiting to see at this point, but overall sentiment is strong. I mean, right now, Oracle's trading at 201. You mentioned they are a little under pressure today, but the average price target right now is 342. So, I mean, that's a roughly 40+%, upside move from where they're trading right now. Street high is 430, while the street low is only 175, only $25 off of where we are right now. So, sentiment's still strong in terms of the AI trade, I think.
Yep. You got to watch the technicals on that. It's broken through its 200-day moving average to the downside, also down 41.6% from those all-time highs that we saw in September. Thanks to Marley Kayden here for joining us. But now let's bring in our next guest to trade this. And we're going to talk to Dan Deming. He's a managing partner at KKM Financial. Welcome back to the show, Dan.
Hi, Tom. How you doing?
I'm doing good. Long time no see.
I
know. It's unfortunate, but happy Black Friday here. Dan,
Hey.
So we're talking Oracle. We've talked about, the fundamentals are maybe still there, but now the commitments with OpenAI, trying to hit sentiment here from the investor at this point. Give me your take here on Oracle before we take a look at a trade here.
Yeah, Tom, I think, that's the question right now is the debt structuring something that they can manage moving forward? And there's a wide dispersion as far as the expectations there. Hence why we did see Oracle come off so dramatically here in the last couple of months. And, if you look at the price action here, Tom, certainly around this 200 level valuation, so much more compelling. It does appear that it's trying to form a bottom here after spiking down below 190 briefly. And now we're seeing at least some buying pressure here and some stabilization short term. I think, longer term, just based on the evolution of the AI space and just some of the dynamics, that Oracle's still in a good position. But yeah, there's no question relative to some of the competitors out there, they've taken on a massive amount of debt, and will they be able to manage that moving forward? But I still think here it's oversold. We look at it as a possibility of regaining some traction here, getting back up. I don't know if it's going to challenge that 350 level anytime soon, but at least I think we'll see a 50% retracement back up to the 275 level. And if that's the case, then I'm looking from a short-term perspective to capture at least maybe a bounce here off this 200 level.
All right. So, Dan, that's good because, we're down below that 200-day simple moving average. It did get peak back above there, but now a little bit weaker today. So go ahead and break down your trade example here for us.
Yeah, this is a short-dated trade example, Tom, and 21 days out, just December. Define risk. I think that's a key right now, given the price movement we've seen in the stock over the last couple of months. And I'm looking at the December 200, 230 call spread. It was when we were trading just below 200, you could do it for about $9. It's a little bit better than 2-to-1 risk reward on this call spread to the upside. But I still think that if we see some stabilization, 230, I think it could be hit very quickly. We've seen this price movement in the stock, quite dramatic volatility. So I do think that we could challenge that 230 level here over the next 3 weeks if we see some stability in the price action. And again, like I said, define risk though. If we, there's still some outliers here, and it's certainly the trade example I gave for Oracle about a month ago was a risk reversal, which got run over. So I think the key here in my mindset is looking forward, at least short term, is define risk, but able to capture some upside should we see a nice bounce here off the 200 level.
Yeah, let's break this one down. December 19th monthly option, so 3 weeks to expiration, 21 days. Buying that slightly in the money 200 strike call, selling the 230 call against it. Dan, when I look at this, I always look at trades as, somebody might go, well, why not just buy the 200 strike call? And I'm like, well, you're going to pay $15 for that. So you got $1,500 in risk. And over the next 3 weeks, do you really expect it on a percentage basis to go much above 230, if at all? And that's why you can sell the 230 call against that, reduce risk by over $4.5, nearly $5 to where this spread might cost you around $10 because the stock has bounced off a low. But isn't that one of the keys, Dan, when you're looking at option strategies like this where, hey, let's offset some of the costs on the bullish part of this trade, right?
Yeah, absolutely, Tom. That's certainly the thought process here is to lower your break even and still have a nice capture zone to the upside. So that's the idea of selling that upside call, lowers your break even. You don't need to have, quite the price appreciation to have it intrinsically become of value. And you still have, better than 2-to-1 risk reward profile on this should we see a run back to 230. Of course, if we get above 230, all right. But you know what? You had some defined risk, you lowered your risk profile, and you're able to capture a significant amount of upside on a bounce if we see the stock continue to move higher.
Yep. And, on a percentage basis to get above 230, you're still talking over 20% that it's got to get up there. So, yeah, offsetting some of the costs on this bullish trade. All right. Great stuff, Dan. Appreciate it. Have a great weekend.
Thanks. You too. Appreciate it. Good to see you.
Yep. Good seeing you too, Dan. That's Dan Deming, managing partner for KKM Financial.